Hello, this is a video about value investing. Why do I do these videos? Well, because uncertainty creates anxiety, understanding helps create confidence, and the future will always be uncertain, but your financial decisions don't have to be. For over 30 years I've seen the same questions come up over and over. Will my money last? What if the market crashes? Am I making the right decisions? How do I stay calm when everyone else is panicking? And many more, all to do with uncertainty. So my videos are to help answer these questions for you. Today's question is, how do I reduce risk? Why do some investors get it wrong? It's not because they're unintelligent, it's more like because they're human. When everyone is excited, it's hard not to get excited as well. When everyone is panicking, it's hard not to panic. We've all done it. Let's look at risk a little deeper. Risk isn't just what you buy, it's also what you pay. Most people think risk is choosing the wrong investment. I think paying too much for a good investment is just as risky. Risk isn't what you buy, it's also what you pay. Let's look at a little bit deeper. Imagine buying a house. Would you rather pay $800,000 or 1.2 million for the same house? Of course, you'd rather pay 800,000. Why? Because you've taken less risk. Shares work the same way. For example, Telstra shares. Remember the first lot came out at $3.30, and then the second lot came out at $7.40. They're now worth about $5. One did okay, and the other lost money. How do you stop that happening? Surprisingly, it's quite simple. Don't pay too much. That's the whole idea. It even has a name, value investing. Here's what I mean. Would you rather buy something when it's expensive or when it's on sale? Value investing is buying good investments when they're on sale. Here's what Warren Buffett said. Whether you're talking about socks or stocks, and stocks being shares, I like buying quality merchandise when it is marked down. And notice it's quality as in capitals when it's marked down. Should I buy? When should I buy? When shouldn't I buy? So how do we know what's good value? Warren Buffett says, price is what you pay, value is what you get. With the share, what you get is a return, dividends, and an increase in price. An investment has two prices, what it's worth and what people will pay. And sometimes those two things are very different. So back to Telstra, the first lot of shares got better than average dividends, and the price went from $3 to $5. Value investing helps you buy the first lot, not the second. How do you know what is good value? The best way I know how is the ratio of price to earnings. I didn't invent this, I borrowed it from Warren Buffett. And if you're going to copy someone, he's not a bad person to copy. So now the obvious question becomes, how do you know if something is expensive? Well, over the years, I've found that one measure that's simple. It's called the PE ratio. This is the price to earnings ratio. Price is what you pay, earnings is what you get. And here we go for an example. So here's an investment, it's $100 and the earnings $5, which means the PE ratio is 20. Another way to look at this, a PE ratio of 20 means it takes 20 years to get your money back. So this is 20 times bigger, the price is 20 times bigger than the earnings. And here we've got three different investments. They've all got about the same earnings, but they're different prices. This one here takes 20 years to get your money back. This one takes 15 years to get your money back, and this one 10 years. Which would you prefer? The green one. Is high or low PE better? Well, this one here, the PE is low. This one's here, the PE is high. This one takes 10 years to get your money back. This one 20 years. So I'm going to bet this one. Lower is better. Compared to what? Here's an example. This is the long-term history of the Australian share market PE ratio. And you can see here is the average. And this is worse value because it's higher. And that's better value. Okay, so only buy good value. Over 15 is worse value. Under 15 is better value. But does it work? Well, here's some history. This is the US share market, and what it shows is the earnings that you get from when you buy an investment, buy into the market over 10 years, and this is the PE ratio. So here, if you look at 25, if you in the US market, this is a trend, it's on average. On average, if you bought in at 25, you can expect a minus 5% return for every one of 10 years coming on average. Here, PE ratio 15, over history, if you bought at 15, then the average likely return is about 10% per year. Now, what this shows is when you buy lower PE, you're more likely to get higher returns, and therefore it's less risk. And when if you buy high PE, you're likely to get poor returns, that's a bad risk in my book. Now this is the Australian share market, and all these little dots are every month between 1962 to 2000. At this, let's take this one here. You can see the PE ratio there's about 7.5, and the returns that when you bought that month, the returns per year after that was over 20%. That's amazing. And down here it's lower, but the trend line is what counts. And you can see that down here, when you buy at higher PEs, the returns aren't as good as when you buy in at the lower PEs. Risks and downsides, it's not a guarantee, it's just less risk and a greater chance of a better return. One of the risks is if you don't buy now, the market may go up for a long time. PE ratios may never come down, and when you buy good value, the market may still go down. And another risk is earnings may fall in the future. Now let's have a look at this one. The market may continue to go up. So here we are now, and this is just a make-believe thing, just for illustration. Where will the market go in the future? Who knows? It could go up, it could go down, we don't know. The PE ratio, let's just look at an example. The PE ratio here is 16 and we don't buy. The market goes up, which means you never buy. Missed out on making money. But history shows that sometimes it's good value, sometimes it's bad value. So you'll probably get your chance at some stage. The benefits of value investing is we want less risk, we want a better chance of a good return, and value investing gives us that, as you can see from this chart here. The better value you buy, the better chance you're likely to get. Why value matters? When you pay too much, everything has to go perfectly from that point forward. When you buy at a good price, you've got a bigger margin for error. Remember the Telstra story? Well, the first lot was $3.33 and the second lot $7.40, and the price now about $5, just as a bit of a recap. With the first lot, the PE ratio was 10. With the second lot, the PE ratio was 20, and the price is now $5. So you would have been better off buying the first lot, and I would have bought the first lot if I had known the PE was 10, but I wasn't looking at it at the time. So the PE ratio does matter. Now that you have a way to measure value, you might have not bought the second lot. A surprising benefit: I have a client who wanted to retire, but she didn't have enough money. Then along came the COVID crash, and she bought such good value and made such a good return in the year or so after that, she was able to retire. So in summary, how do you reduce risk? Don't pay too much. That's what value investing is. It won't remove every risk, but it can reduce risk and improve your chance of achieving a good long-term return. Successful investing isn't about predicting the future. It's about making sensible decisions when nobody knows what will happen next. Would you like to know more? Visit my website, give me a call, or check out more videos on my YouTube channel. And here's a general advice warning. And this is a simple Gavinized version. I'll have a more official one after this. This presentation is for educational purposes only. The information is reasonably accurate. Some poetic license has been taken to a small degree for explanation purposes to make it easier to understand. And most importantly, get advice from an expert before doing anything. And the next one is the official version. See, I'll leave you to, if you want to read this, pause it and pause the video and have a read. Otherwise, I'm going to move on. And remember, uncertainty creates anxiety. Understanding creates confidence. Thank you.